Okay, so you want to own a Porsche, not drive one.
Own the dealership, the showroom, the lot full of 911s. Sell them to your neighbors, take a cut on every deal. That's the picture. Glass windows, a raised hood ornament, a sign.
Here's the good news. Unlike some brands, that dealership exists.
Here's the bad news. You almost certainly can't buy into it.
Porsche still sells through independent franchise dealers. About 90% of them across the United States, give or take.
Each one privately owned, not run directly by Porsche itself. So on paper, the door is open. In practice, it's nearly sealed. Porsche Cars North America approves every single dealer.
They decide who gets a franchise and where it can operate. New dealership approvals are rare. Existing ones rarely sell.
When one does sell, it moves quietly, dealer to dealer. Outsiders almost never get first look at the opportunity. You'd need capital most people can't imagine gathering. Land, a purpose-built showroom, service bays, certified staff.
Startup costs for a single franchise can run into the tens of millions. And that's before Porsche even considers your application.
They want the track record. Other dealerships. Other brands.
A name PCNA already recognizes and already trusts.
A first-time buyer with no automotive history rarely gets a look.
Even wealthy outsiders get quietly steered toward a no.
So most people who buy a Porsche business buy something else. They buy a franchise from an existing owner who's already in.
That's an acquisition, not an application. A different game entirely. Let's talk about what a Porsche dealer actually earns. New car margins in luxury retail are famously thin. The real profit sits in service, parts, and certified pre-owned sales.
A Devant Autonoden owner spends years coming back for maintenance.
That recurring service revenue is worth more than the original sale.
It's why an existing franchise is worth so much more than a new one.
You're not just buying cars, you're buying a customer relationship.
One that renews itself every oil change and every recall.
So if the storefront route is nearly closed, what else is open?
A few real paths exist here, just like with other iconic brands.
The first is becoming an independent certified service provider. Porsche runs training and certification for outside repair shops. Certified shops can do warranty-adjacent work on aging vehicles.
It requires specialized tools, diagnostic software, and real capital.
It's a genuine business. It's also nowhere near owning Porsche.
A second path is supplying the company instead of selling for it. Porsche outsources components across a massive supplier network. Parts, materials, specialized engineering, logistics, and more. Getting into that supply chain takes years of relationship building.
It's steady, serious business. It's also invisible to the public.
A third path skips storefronts and factories completely. Buy shares.
Because unlike some car companies, Porsche is actually public now. That wasn't always true. This part of the story is fairly new. For most of its history, Porsche was privately controlled, held tightly by the Porsche and Peach families for generations.
Then, in 2022, something unusual happened. Porsche went public. Not the whole company, a specific slice of it, carefully designed. Porsche AG listed on the Frankfurt Exchange under the ticker P. David Adin Adin.
Cute ticker, very deliberate. The shares sold are preference shares. Preference shares get a share of profit. They carry no voting rights.
So buying stock gets you economic exposure, not a say in anything. The people who actually vote on Porsche's direction sit elsewhere. Let's talk about who actually controls the company today. Volkswagen AG owns roughly 77% of Porsche AG's shares. That's the parent group. Porsche has been part of VW for over a decade. A separate entity, Porsche SE, owns another meaningful slice.
Around 12.5% of Porsche AG sits with Porsche SE directly.
A sovereign wealth fund, Qatar's QIA, holds a smaller piece too. The rest, the small public float, is what P. Dinizit shareholders actually own.
Now here's where it gets genuinely strange. Porsche SE isn't simple either.
Porsche SE is a holding company, not a car maker at all. It doesn't build a single vehicle. It just holds ownership stakes.
Its biggest asset isn't Porsche AG, it's Volkswagen AG itself.
Porsche SE holds a large voting stake in Volkswagen's ordinary shares.
enough to give the Porsche and Pitch families effective control of VW. So the family that built Porsche cars now controls Volkswagen instead.
And Volkswagen, in turn, owns 3/4 of Porsche AG. Porsche essentially owns its own parent's parent, in a strange loop.
It sounds confusing because it is genuinely confusing on purpose. This structure exists to keep family control locked in permanently. No outside investor can simply buy enough shares to take over. The voting power was carved out and protected before the IPO happened. Retail investors were only ever offered the profit, never the control.
That single design decision defines what owning Porsche really means. To understand why this exists, you have to go back to 2008.
Porsche once tried something audacious. It tried to buy Volkswagen.
At the time, Porsche was the smaller company by revenue, by far.
But Porsche quietly built up options and derivatives on VW stock. The plan was to secretly gain control of a company many times its size. For a moment, it nearly worked. Porsche's ambition was staggering. Then the financial crisis hit, and the position became a trap. VW's stock price spiked wildly as short sellers scrambled to cover.
Porsche's derivative bets, meant to fund a takeover, backfired hard. The company that tried to swallow Volkswagen nearly drowned instead.
Porsche ended up billions of euros in debt from the failed maneuver.
The hunter became critically wounded, needing rescue urgently.
In the end, Volkswagen turned around and acquired Porsche instead. The predator became the target in one of history's strangest reversals. That's the origin of the ownership structure that exists today.
The families kept influence by folding into VW's larger structure.
Porsche SE emerged from the wreckage as the family's holding vehicle.
It's less a company and more a fortress built after a near collapse.
So when you buy P911 stock, you're buying into that fortress's economy, not its walls, just a small slice of what happens inside them. Let's actually look at what that economy produces today. Porsche AG reported revenue of about 36,3 billion euros in 2025.
That's a serious number for a company making relatively few cars.
Production sat around 279,000 vehicles for the entire year.
Compare that to mass manufacturers building millions annually. Porsche's entire strategy depends on scarcity, not volume.
Fewer cars, higher margins, a brand people wait for. But 2025's profit numbers told a more complicated story. Operating income came in at just 413 million euros for the year.
That's a thin result for a company of Porsche's size and reputation. Net income landed closer to 1 billion euros after other adjustments.
Something clearly squeezed the margins that used to run much fatter. Part of the answer is Porsche's rocky pivot toward electric vehicles.
The company once promised an aggressive shift to fully electric models. Then demand for EVs in key markets came in weaker than projected.
China, once a reliable growth engine, slowed down significantly.
Porsche scaled back some electric plans and reinvested in combustion. Reversing a strategy this large is never free. It shows up on the books. Battery and platform investments don't simply disappear when plans shift.
Leadership changed too, as the company recalibrated its direction. None of this makes Porsche fragile. It makes it a company mid-pivot. Mid-pivot companies are exactly where stock prices get interesting. As of August 2026, P911 shares trade somewhere around 44 to 45 euros.
That puts Porsche AG's market value in the neighborhood of 40 billion euros.
Porsche SE, the family holding company, trades separately entirely. Its shares sit in the high 20 euro range, valuing it near 8.5 billion euros.
Two tickers, two very different things, easy for outsiders to confuse. Buying P911 buys you Porsche, the car maker's economics, roughly.
Buying Porsche SE buys you a sliver of the family's control empire. Neither one buys you a seat anywhere near the actual decisions. Let's put real numbers on what an investor's money actually buys. $10,000 at roughly 45 euros a share buys around 200 shares. That assumes a simple currency conversion at a typical recent rate. Porsche AG does pay a dividend, unlike some growth-focused automakers. The yield has hovered in the low single digits in recent periods. It's a modest, unexciting return. Nothing like a lottery ticket. The stock itself has been fairly range-bound through much of 2026.
Down slightly year to date, well off its post-IPO highs from 2022.
Analysts mostly rated a hold, not a screaming buy or sell. This isn't the hype stock. It behaves like a mature industrial name.
Compare that to the independent certified shop route from earlier.
That path demands real operational skill and real daily effort.
It also produces active income immediately once the doors open. The stock path demands patience and tolerance for thin, steady returns. Neither path hands you a badge, a logo, or any real influence. Owning shares in the company that makes the 911 still feels different. It feels closer to owning the car than it actually legally is.
That gap between feeling and legal reality runs through this entire story.
Let's step back and look at how this brand actually got here.
Ferdinand Porsche founded the company in Stuttgart back in 1931.
It began as an engineering consultancy, not a car manufacturer at all.
Early work included designing vehicles for other companies entirely. The first car to actually wear the Porsche name arrived in 1948.
The 356, small and light, built the foundation of the brand's identity. The 911 followed in 1963 and became the company's defining shape.
That silhouette has barely changed in over 60 years of production.
Continuity like that is rare in an industry obsessed with reinvention. It's part of why the brand commands the loyalty and pricing it does.
The Cayenne SUV arrived decades later and changed everything financially. Purists grumbled. The SUV quietly became the company's profit engine. The Macan followed, expanding that same formula into a smaller size.
SUVs now fund the sports cars that define the brand's public image. It's a pattern seen across nearly every performance car maker today. The Taycan arrived as Porsche's first serious electric vehicle. It proved the Porsche could be fast, refined, and battery-powered. It also arrived into a market that cooled faster than expected. Elon Musk's Tesla is often the reference point in comparing the two.
Two very different business models aimed at overlapping customers. One sells directly with no dealers at all. One relies on them entirely.
One trades like a technology stock. One trades like an industrial one.
Porsche's volatility looks calm next to Tesla's wild daily swings. That calmness is exactly what a dividend-focused investor wants. It's exactly what a growth chaser finds completely uninteresting.
Let's go back to the dealership path and look closer at the economics. A single franchise location can represent tens of millions in real estate. Brand standards dictate architecture, lighting, even the flooring. Porsche enforces a consistent look across every store worldwide.
That consistency costs the dealer money, not the manufacturer. Dealers absorb renovation costs whenever brand standards update. It's the price of admission for carrying that badge on the building.
In exchange, dealers get access to allocation, a share of new inventory. High-demand models are often allocated, not simply ordered freely. A dealer's history and performance can influence what they receive. Sell well, behave well, and better allocation tends to follow.
It's a relationship built on trust accumulated over years, not months. That's the opposite of a direct sales model, with no middleman at all.
Porsche has experimented with online ordering tools in some markets,
but delivery and paperwork still typically happen through a dealer.
The dealer network remains the backbone of how cars actually change hands. Threatening that network would mean rewriting decades of relationships. So, unlike some newer automakers, Porsche has little incentive to. The dealers are partners in the brand story, not just middlemen.
That partnership is exactly what makes franchises so hard to acquire.
Nobody wants to sell into a relationship that valuable lightly. So where does that leave someone starting from zero, watching all this? The dealership door is technically open and functionally very narrow. The certified shop path is real, but capital heavy and slow to build.
The supplier path takes years of relationships most people never start.
The stock path is the only door open to literally anyone instantly.
It's also the path that hands you the least influence of all four.
A share of 911 peso makes you a bystander to decisions made far above you.
A share of Porsche SE gets you closer to the family's fortress walls.
Neither one lets you touch the blueprint of how any of it was built. The blueprint itself traces back to a failed takeover in 2008.
A near collapse that reshaped who actually controls this brand today.
Most people watching a 911 drive-by have no idea that story exists. They see a shape that hasn't changed in 6 decades. nothing more. They don't see Volkswagen's 75% stake sitting behind it. They don't see the family holding company steering from further back.
They don't see the derivative trade that almost sank the whole thing.
The car in front of them is the smallest, simplest part of the story. Everything that actually controls it sits several layers underneath. That's true of almost every iconic brand people think they understand.
The product is visible. The structure behind it almost never is.
You can buy the stock. You can service the cars. You can supply the parts. You can never actually buy your way into that family's fortress. It was built, quite literally, to survive exactly that kind of attempt.
Once, before, someone already tried to take the whole thing over.
The people who actually understand this business stop chasing the badge.
They're the ones who understand the structure as closely as they understand the car.